I want to talk on accounting family. As every human being belongs to one or two families, so every transaction in accounting belongs to a particular family. And every family have their own behavior, their attitude, their manners. The same to accounting families. Every transaction in accounting have a behavior, has how it works. So as long as accounting is concerned, every transaction must belong to a particular family. This is accounting for beginners, students that are learning accounting for the first time, the first timers, those that are very much new in the field of accounting. This program belongs to you. It will help you to be able to identify accounting transactions anytime, any place, anywhere. At least if not for anything, you know that this transaction belongs to this family. And since it belongs to this family, it should either be debited or be credited, depending on the reactions, or by bet, what happens to that family. Yes, because by bet, some families in accounting are debit, and by bet, some families in accounting are credited. So we'll be looking at these families in this program in accounting. I took my time to verify that in the field of accounting there are 6 families in accounting. There are 6 families in accounting. The 6 families are: number 1, we have the personal family. Personal family. Personal family. The personal family. Under the personal family, I'll be talking about personal accounts. That is number 1. Personal account is account of persons, account of individuals, account of companies, account of industries, account of firms, account of any legal parastatal. Every business has a name. So whatever the name is in accounting, it belongs to personal account. Names of human beings, names of companies, they are all under personal family. So if you are to give examples of personal accounts, you can start calling the names of people you know. Yes. You can say Johnson's account, Abraham's account, Chinedu's account, Chukwudi's account, Sarah's account, and so on and so forth. These are personal accounts on the side of individuals. Names of church. So if you are asked, give examples of a personal account, you can start calling names of church you know around you. So far the church is a registered church. The name given to it in Corporate Affairs Commission belongs to personal account. Names of companies, you can mention as many companies as possible. All of them falls under the personal account. Names of school, so these are personal accounts. So if you can give as many examples of personal accounts. But the main thing you should know about this personal account, which is the most regarded aspect of what I'm talking about, is the reaction of personal families. The reaction of personal families. The reaction of personal families. Personal account, by birth, they were twin. One of the twin is the receiver. And the other twin is the giver. Yes, personal accounts are in two perspectives. So I would say that two people were born in personal family. Number one is the receiver, and number two is the giver. So when you read a transaction, try to identify who is who in that transaction. Is the person involved in that transaction a receiver? Is the person involved in that transaction a giver? And what did the law say? What's the rule in accounting? If the person involved is a receiver, the law said you should credit the person. Yes. Sorry, you should debit the person if the person is a receiver. Then if the person is a giver, the law said the person will be credited. Because accounting is all about debit and credit. What to debit and when do you do that? So once you identify that a particular account is a personal account, ask yourself a question. Is this item going to be debited or credited? How will you know? You will only know when you know the condition of the person, whether the person is a receiver or the person is a giver. So if the person is a receiver, you debit him. If he is a giver, you credit him. So this is how personal account works. Debit the receiver, credit the giver. Now the big question here is, where do you do this debit and where do you do this credit? The debit and the credit to be done in the ledger. Anytime you are preparing the ledger, the ledger is the main book of accounts. Ledger is the principal book of accounts. So whenever you are preparing the ledger and you see a personal account and the person is a receiver, go to that ledger and debit the person. Whenever you're preparing an account of ledger and you verify that the person is giving out, the person involved is giving out, go to that ledger and credit the person. In the next package, we shall be showing you how to make these entries. This package is designed to guide you on the six accounting families as derived by C Tutors Academy. Okay. So you have seen that the first family, the first person born in this family is a twin under personal family. One of the twin is the receiver. The other twin is the giver. The receiver is debited and the giver is credited in the ledger. Or if you are preparing journal proper, still the same entry. Journal proper. The same way journal ledger reacts is the same way journal proper reacts. So if something is debited in the ledger, it will also be debited in the journal proper. And even the trial balance. Trial balance is the list of balances extracted from the ledger. The summary of everything you did in the ledger is done in the trial balance. So wherever it is in the ledger, so shall it be in the trial balance, in the journal proper. Okay. Number 2. The second family in accounting, under the accounting families. The second family is expenditure family. Yes, expenditure family. Expenditure in accounting is all the cash outflow from a business. So I will say that in this family, anything that has to do with payments made by a business is called expenditure, or it belongs to expenditure family. But one thing you should know is this: some expenses made by businesses are done on regular basis, while some expenses made by businesses are done irregularly. So I want you to look at expenses in two platforms: the regular expenses, the recurrent expenses, the constant expenses of a business. Then on the other side, we'll talk about expenses that are not constant. Now I want you to know that when I'm talking about expenses, I mean the expenses that are constant in business. Those ones that are not constant will go to another family, which I will show you in this platform. So expenditure family are those expenses a business makes on regular basis, like rent, payment of rent. Business pays rent every month. Business pays rent every month constantly. So rent is a very good example of expenditure. Rent belongs to the family of expenditure. Something like salaries. Business pays salaries to their employees as at when due, and it's done on constant basis. So salaries is a very good example of expenditure. Something like bank charges. The bank charges you charges you for keeping records of your financial transactions, and they do this on constant basis. Something like light and heat. Entertainment. Light and heat is a kind of entertainment in a business. Entertainment is any kind of refreshment. These are expenses, and they are done on regular basis. Something like depreciation of fixed assets. So long as you are using your fixed asset constantly, they will be depreciating, wear and tear will be occurring. So this is done on regular basis. Those expenses that are done on regular basis are expenses. They belong to the family of expenditure. So whatever that is a payment made by a business is regarded as belonging to family of expenditure. Now the main thing you should know is what happens to expenditure by bet. How does expenditure react? The rule is that every expenditure is debited by bet. Every expenditure is debit by bet. So whenever expenditure occurs, or you identify an item to be expenditure in your ledger, put it on the debit side. That's all. Then number three is income. Income is regarded as all cash inflow into a business. Whatsoever that brings money to a business is called income. Now I want you to know that some income are regular while some are irregular. Some income are regular while some are irregular. Those income which are regular is classified under the income family. Then those ones that are not regular is classified to another family in accounting. Remember that I told you that there are 6 in number. I'm discussing the third one right now. Income family. So whatever that brings money to a business is called income. If it is on regular basis, it is income. Then if it is not on regular basis, it has another family to be discussed. So whatever that brings money to a business is called income. Example, sales. When business sell goods, they collect money. Commission received. When business receive commission by making sales for someone or second party, it is income. Discount received. When business buy goods from their suppliers, they receive discount from these suppliers. When they receive discounts, they classify it as income. Discount received. So whatever that brings money to a business is called income. Business donations. If there are donations to the business, maybe the business carried out 1 or 2 programs inviting people or seminar or whatever, and people donated to the business, all those donations are under the class of income family. So the main thing is, what is the rule guiding income? In accounting, every income by birth is credited. Every income by birth is credited. So when you see an income and you are preparing ledger, go to the credit side and record it. Then number 4, we talk about assets family. Asset family. Asset is what belongs to a business. Asset is what a business has. Asset is whatever a business buys and uses it for generation of income. Whatever a business buy with their money and they are using it to generate income, it is called assets. Asset is classified into 2. The non-current asset, which is called the fixed asset. Some assets are fixed. Then, and the current asset. Whether current or non-current asset is asset. Whatever that belongs to a business is called asset. Something like furnitures and fittings. A business buys furnitures and fittings so that they will use them to generate revenue. And it doesn't mean that they are selling furnitures and fittings. They are using it for office use. Something like plant and machineries. These are very good examples of assets. Motor vehicles, land and building, equipment, stock, which might be called inventory now. Debtors, all the people that are owing the business, they are under the class of asset family. Cash, the cash in hand of a business is also a very good example of an asset. The cash at bank is also a very good example of an asset. All these are assets which a business makes use of that belongs to a business. Prepayments. Prepayments are payments made in advance. When the business pays in advance, or when you pay something in advance, until that thing you paid for is fully consumed, it is an asset. So if you pay for a rent for 12 months and you have lived for 3 months, you still have access to 9 months. And that is why prepayments are what? Assets. So asset family is those things that business buy to use to generate revenue, whether current or non-current. The law said that by birth, every asset is debited. Every asset is debited. So when you see an asset in a question, when you read a question, try to identify the asset involved. If there's an asset involved there, what you should do is to go and debit it. In future time, an asset may decide to be disposed. A firm that has been using their furniture and fittings may decide to change to new ones, and they would start disposing their previous assets. When asset comes to the point of sale, just to replace them, to buy new ones, and they want to sell it, it will now take position of the credit. But by birth, every asset should be debited. So during disposal, you can credit them. That is how it works. During disposal, you credit them. But the main position of an asset is on the debit in the ledger. But if you are disposing them, you credit them. Number 5, liability. We have the liability family. Liabilities are those things that does not belong to a business, or you can equally say what a business is owing the outsiders. Whatever a business is using to generate revenue that does not belong to the business is titled liability. We have the long-term liability, we have the short-term liability, or current liability and non-current liabilities. Whether current or non-current, whether short or long, liability is liability, and the rule is that every liability should be credited. When you identify them, you credit it. Every liability is credited in the ledger. Now, what should be the examples of these liabilities? Like capital. Capital is currently known as equity. The money used in starting business. Business borrow these funds from the owner of the business, and thereby the business is owing the owner. So we can now say that capital is a liability because the business is owing the owner. Something like profit. Profit is also a liability because profit does not belong to the business. Whenever a business makes profit, the owner will come to collect the money and use it for something else, which means it does not belong to the business. Whatever that is used to run a business came from the owner of that business, thereby the business is owing the owner. And the purpose of establishing a business is to generate profit and revenue. And when this profit comes, the owner will take it up for something else. So it does not belong to the business, a liability. Creditors. Creditors are the people the firm is owing, the suppliers the firm is owing. The firm buy goods and they do not pay, or they pay part, they have not completed the money. That means creditors, they are owing, it's a liability. We have accruals. Accruals are outstanding payments to be made by business. If a business is owing someone or pay part of the money, hoping to pay the remaining in the future, that remaining balance is called accrual. It's a liability. Loan. Business borrow funds to cover business losses or the strength of the business. When they borrow this money, is called loan. Loan is a liability. The rule is that when you see these transactions, go to the credit side because by birth they are all credited. Then at a time when you are paying these liabilities, when these liabilities are to be paid back, during that time, it should be debited. So when you are paying liabilities, it should be debited, but by birth, every liability is credited. So when you are settling liabilities, when you are paying them off, they should now go to debit. But by birth, remember that every liability should be debited. When you say liability, debit it. Remember that I'm talking about 6 accounting families. There are 6 in number. I have mentioned 5 and how to record them in the ledger. In the second part of this platform or these tutorials, I'll be talking about making the entries direct in the ledger, so that you see how these things are being done in the ledger. So I want you to keep subscribing to our channels and learn more academically, most especially for accounting students, business students, management students. Always come to See Tutors Academy in YouTube and learn more. You can equally call my number, the key person for consultancy levels, 00334174775. I repeat, 08033417475. For any consultancy, you can speak to the key person direct, talk with him and learn more. So that is all about liability. Liabilities are what a business is owing outsiders. Whenever you see them in the ledger, put them on the credit side. When they are settled, put them on the debit side. Finally, I want to talk about adjustment. That's the last one. Adjustment. Adjustment family. Adjustment family. Or provision. You can equally say or provision. This is a process of setting some money aside to cover unforeseen circumstances. There's a principle in accounting called going concern concept, which is telling you that a business will continue to live forever and ever. What will make a business to continue to live forever and ever is when the business is obeying the whole principles guiding business. Any business that obeys the principles of business can never die. It will continue to live. I've seen a lot of businesses since I was born. The business has stayed there. These are called business. Every business should continue to live. Adjustment is what a business do that makes them to be retained in the business. If you are selling goods, you have a shop and you are selling goods and you sell some goods on credit. When you sell goods on credit and keep selling goods on credit to your customers, every time they come you sell on credit, before you know it you run out of business. But if you are a good businessman, when you sell on credit you make adjustments immediately to cover your bad debt. Should in case these people did not return this money, what do? So you must, when you are giving out something on credit, make sure you have another source where you can replace that. So the process of replacing the credit sales you made in your office, in your company, is what is called adjustment. Somebody buys good from you worth 3,000 on credit and the person leave. Once the person leave, look for 3,000 somewhere else to cover that 3,000, so that when you bring it back, you make your adjustments. So the process of trying to make adjustment to cover your bad debts in accounting is called adjustment. There are so many adjustments in accounting, but in primary accounting, one of the major one is adjustment for bad debts. When you give out some goods on credit, they don't pay you, you have to make an adjustment somewhere else to cover it up. Otherwise, the business will die off. Adjustment for bad debts. We have it for depreciation. Adjustment for depreciation. But the question is, what happens? How does this family react? Every adjustment, every provision in accounting, by birth, all are credited. All of them are credited. So this is what I call the 6 accounting families. 6 accounting families. Every transaction, mention it, all of them are on this screen now. Whatever money can buy, whatever a business does, whatever transaction that a business undergoes is on this screen right now. Mention it, it gets somewhere to be. Is it sales? Sales is an income, you put it under income. Is it purchases? You can put it under expenditure because you purchase regularly. Is it purchase of motor vehicle? Purchase of motor vehicle is expenditure, but it doesn't come regularly, so you take it to asset. Is it acquisition of land and building? Land and building, you don't acquire land and building by business every time, so take it to asset family. Is it adjustment for bad debt? Maybe your debtor, you're feeling that the debtor will not pay and you bring money from somewhere else to cover it up, take it to number 6, adjustment family. Is it a personal account? You sold goods to Emeka, sold goods to Johnson, purchased goods from Anna, you purchased from Ananko, purchased from anywhere they mention the name. So that one is involving 2 people, the receiver and the giver. Debit the receiver and credit the giver. So at this, we shall be dropping this.